You're unprofitable. I'm here to fix that. I'm going to do my job right now and show you exactly what I look for as a 19-year-old day trader who's been trading for 3.5 years and has been able to request 5-figure payouts on platforms like Alpha and Tradeify. The first thing that I'm going to tell you is to not change your strategy. This is the last video that you should be watching. You cannot strategy hop. That's going to stunt your progression like crazy. So first things first, there's a couple things that you got to look for. Ideally, the first thing is you got to identify, okay, are market conditions even clean? As soon as you hop on the charts, you got to realize, okay, what did price do on overnight? Did we move crazy? Did we have an insane amount of volatility? If we did, then from there, you can identify like, okay, if on Sunday we had a crazy move, Monday we have no news, we're probably going to chop a little bit in New York AM session. So from there, identify that market conditions. Boom. From there, you got to identify two things, all right? Your draw on liquidity and your bias. That is single-handedly the most important step. So you got to identify, okay, your bias. Where do I think price is going to go? Up or down? Bullish or bearish? From there, you got to be even more specific. So, okay, we're bullish. Let's just say we're bullish, right? For this example. Now, what specifically do I want price to go up to? Okay, what specifically am I going to target? Now, once you understand those two things, this is where things start to get nice, all right? And by the way, for you to identify your draw liquidity and your bias, you got to use the daily time frame, obviously, then 4-hour time frame, and then the 1 hour. Okay, those are the time frames that you're going to use to identify, okay, do we have any liquidity sweeps? Do we have SMT? Do we have imbalances in the market? Do we have other PD arrays that can give us a narrative to where we think price is going to go for that day? From there, we scale into the 15-minute time frame. That's where we identify that 15-minute PD array that's either aligned with our bias and is targeting our draw. For this case, we're in the 1 hour time frame. So what do we have here? We tap into this 1 hour imbalance. From there, I scale into the 1 minute time frame. As soon as we create that 15-minute fair value gap, now from there, I see that we have this higher time frame SMT. Why? Because I'm looking at ES as well. We have everything else that's aligned. Now, what's the next step? Our next step is that entry model. So there's kind of two things that you have to look for in this situation. The first thing is, okay, if we sweep internal lows or internal highs, whatever it is, all right, if our bias is bullish, meaning we're going to take a long, we should be sweeping internal lows and we should be creating SMT if you're going to enter off the inverse fair value gap. But if we're going to enter off a normal fair value gap retracement, then it should be something like this. Boom, tap into there. Okay, boom, boom, boom. Okay, let's just say this is our draw right here. Boom. Let's just mark out, we'll mark that out as equal highs. We tap into our 15-minute fair value gap, which is down there. As soon as price taps into that, we start respecting it. How can you tell if price is respecting it? Because we have that displacement candle right there. From there, we create that 1 minute fair value gap, and that is pretty much it. You enter off the retracement. So to recap, if you're going to enter off the inverse fair value gap, I would ideally like to see some SMT and a sweep of internal liquidity, which is exactly what we have for this example right here, which I'm about to play and show you guys how it goes. But if you're going to enter off a normal fair value gap retracement, ideally you got to have that higher time frame fair value gap supporting your bias. From there, you scale into the 1 minute time frame, price taps into that 1 minute fair value gap, you're targeting your draw. That is it. Your stop loss is going to be below that fair value gap candle, just as in this example right here. So let's go ahead and see if this inverse fair value gap plays out. Okay. Boom, boom, boom. Beautiful. So this trade I actually took last Friday, which is a trade that 5 of my students took. One of them actually requested a payout on it, which is insane. But this is exactly it. All right, so this is an A+ setup for an inverse fair value gap entry. Now, a normal fair value gap retracement entry, an A+ setup would look like, okay, you have your bias, your draw liquidity, market conditions are clear, your draw is high. Now, what does that mean? That means that your draw is either previous day highs, previous day lows, session highs, session lows, data highs, data lows, stuff like that. That will give you that narrative. Now, ideally, you want to use a 15-minute fair value gap. But sometimes if price is pretty close to the draw, then you would use a 5-minute fair value gap targeting your draw. For this hypothetical example though, let's imagine there's a 15-minute fair value gap, okay? So I'm going to draw it right here for you guys. Boom, beautiful. So let's say these are our equal highs right here. This right here is our overall draw for the day. Matter of fact, I'm going to make this a little bit lower. We'll do something like that. Now, what does price do? Well, I see us tap into this 15-minute fair value gap, all right? Let's just imagine that this right here is a 15-minute fair value gap. I'll mark it out like this. Boom, 15-minute fair value gap. Now, as soon as price taps into it, that's when I scale to the 1 minute time frame. That's when I'm looking for that model. I see we start to displace a little bit higher. From there, boom, I wait for that fair value gap retracement. That right there is it. As soon as price taps into that, I see it start to respect that. That is my target. Boom, targeting my draw. And my stop loss is going to be below that fair value gap candle. So let's just imagine that there's a 3 consecutive candle pattern, which is that fair value gap. My stop loss would be at the low of that wick, targeting those equal highs or whatever my draw is. Two things here. I'm a trader who goes break even. I'm trading with 7 accounts. It could get pretty risky. I'm trying to preserve capital. That's the mental space that I'm in. So when am I going break even? There's kind of two things here. The only time I'm going to go break even is if, let's say, there is a fair value gap that's right in here that price has not tapped into. That's when I'll move my stop loss to break even. Or if we've closed above a significant high or below a significant high, whatever it is. But this right here is the model. This is everything that I look for. Guys, the most important thing that you can do is to not switch your strategy. Follow your plan and follow your rules. Y'all, I literally been training for 3.5 years, became profitable a year and a half into it, and I still use my training checklist to this day. That's on paper. All my students have access to all that, which is why most of them are getting payouts, passing their funded accounts, and even 10K months. My last student is literally taking a trip to Europe in like a week from now. Follow your plan and follow your rules, guys. This is the system that gets you profitable and above all, keeps you consistent. Comment down below what other videos you guys want me to watch. I know this was a little bit brief, but this is everything that I look for every single day, 9:30 a.m., market open. See you guys.